Hello, everybody. And firstly, I'd really like to thank the Curate team and Ray for the very warm welcome we've had in South Africa. It really is a fantastic chance to come out here, and we very much appreciate it. So, we come from somewhere slightly different. This is not the Evenlode barn. We've got a very similar barn, but we're based in the Cotswold countryside. It's an area of absolutely outstanding natural beauty and really classical English landscapes. Our company, Evenlode Investment, is named after a river which has gradually shaped those landscapes over many, many years. And similarly, we are dedicated to putting together a portfolio of resilient and high-quality companies that we believe can deliver for investors over the longer term. It's not a new strategy. This is something we've been running since 2009, when Hugh and Ben founded the first of the Evenlode funds. But it is something we've extended out into both a global income and more recently a global equity strategy. The Curate Global Quality strategy will be run by James Nodler, Christina and myself. Christina is here as well. You'll get to talk to her later. The success of our approach has enabled us to build both the team and our assets under management. But more importantly, it's also given us the capacity to give back to society. So we have the Evenlode Foundation, to which we donate every year up to 20% of our profits, and that goes to charitable giving and early-stage philanthropic investment. We're employee-owned, and we're fiercely protectable as that. We think that's the best way to deliver on our promise to investors over the long term. And to give you a better flavour of that, please enjoy this video.
The Curate Global Quality Equity Fund, managed by Evenlode Investment, focuses on long-term capital growth by investing in high-quality, cash-generative companies at sensible valuations. All of Evenlode's strategies share a unified investment approach and draw on the extensive research of the entire investment team, who have built up a wealth of proprietary data and insight that is permanently stored and easily accessible on their in-house investment platform called Eddy. This, along with open, evidence-based discussions, help the portfolio managers to make well-informed investment decisions. Additionally, Eddy is equipped with features that support the team across all aspects of the investment process, including modelling tools, portfolio oversight, and engagement and stewardship. Evenlode sees equity investments as partial ownership stakes in real companies. Over time, the fundamental performance of these businesses and their ability to compound free cash flow will dictate returns for shareholders. As such, the Evenlode investment philosophy is focused on three key disciplines: identifying high-quality companies, investing at sensible valuations, and diligently monitoring business risk. Evenlode defines high-quality companies as those that can sustain high returns on invested capital for a long time. These businesses share three key attributes. They have a durable competitive advantage and pricing power. They operate in markets with structural growth drivers. And they invest to incrementally improve their competitive position. Companies with high returns on invested capital are often asset-light, meaning that they generate significant cash flows relative to their asset base. This gives them the ability to continually invest at a high rate, which creates a virtuous circle of compounding cash flows through economic cycles. The investment approach focuses on the active management of business risk to ensure this compounding potential is not interrupted. Valuation risk and liquidity risks are also monitored closely. The portfolio is incrementally nudged into the better value opportunities and away from the more expensive ones. The risk monitoring is enhanced by a proactive approach to stewardship and engagement to encourage positive change. This disciplined approach helps Evenlode to promote portfolio resilience across a wide range of macroeconomic and market conditions. In summary, the Curate Global Quality Equity Fund offers investors the opportunity to access a portfolio of high-quality companies that can generate long-term capital returns, with active risk and valuation management at its heart, managed by the disciplined, multi-generational team at Evenlode.
Great. So, as we say in that video, what we're looking to do is find those high quality cash generative companies and invest at sensible valuation. But you'll hear many different portfolio managers talk to you about quality, and everybody has a slightly different definition. So to really bring that to life, we've done a number of studies, and this is one of them that we talk about a lot. We took all of the MSCI World constituents over the past 20 years, and we looked at discrete 5-year calendar intervals. And we divided them according to high return invested capital businesses and low return businesses, with a cutoff at roughly the weighted average for capital. Now, what we found was somewhat surprising and probably something you won't hear too often from a quality manager, but the high return on capital businesses really barely outperformed at all, a very, very minor difference. So there's a question, what's going on here? And okay, how's that going to work with the quality strategy? Well, if you then look at what actually happened to those businesses over that time period, you can see about 2/3 of those high return businesses managed to preserve those high returns on invested capital over that time. And on average, these businesses returned about 13% per year to shareholders. That's a pretty good outcome. Unfortunately, within those high return on invested capital businesses, there's also about 1/3 of those that take the red escalator down, it's becoming low ROIC businesses over that time period. And these businesses, for investors, well, they stuck. I think it's probably the right way to phrase it. Only a 2% return per year. And that makes sense. The fundamentals of these businesses have materially declined. But also, the market understands that. So there's a re-rating down. And as investors, you definitely suffer. So what is it we're trying to do as quality investors? Well, it's really simple. All we want to do is pick the businesses that stay in that top bar for as long as possible and try and avoid the ones that take that escalator down. And the better our hit rates of finding those top quality businesses, the better our returns over time. And you can see in the table on the right-hand side, if you can hit the 90% hit rate, you'll end up with about 12.3% historically on average. And that's a really significant difference in comparison to a 50% hit rate, which is about 8.6. Now, Evenlode funds, on average, we've managed about 80 to 85%, which we think is pretty impressive, but there's obviously still room to go. Why does that matter for investors? Well, obviously, if you combine those rates with the joys of compounding, over 20 years, you get a really significant difference to the total return to investors. So that's the theory. But how do you do it in practice? Well, we look at the 6 key factors split between quantitative and qualitative. In terms of quantitative, highly profitable, asset-light businesses with limited leverage. These businesses have the cash flow that they can use to self-fund their growth over time. In terms of the qualitative side, there are some things that just make it easier to preserve that return on capital. If you have structural market growth, some sort of demographic driver, it's obvious you're going to find it easier to get more opportunities to get a return on that capital. If you have a durable competitive advantage, typically network effects, switching costs, or a consumer brand, then it's easier to over-participate in that growth. And finally, a continual reinvestment behind that competitive advantage means you can then improve it at the margin and get a real compounding effect across all 3. So that's one side in terms of the opportunity. But what about the risk and that red escalator of sort of bad results? Well, we look at every company in our investable universe and across our portfolios through our own proprietary risk framework, which looks at these 10 risks in particular. Every time we hear new information on a company, or we speak to management, or we learn something, or even something happens in the wider economy, we think about what it means for the company through this lens. This enables us to dynamically change our position sizes to reflect the level of risks the company faces, and therefore give ourselves the best possible chance on a weighted basis of staying in that top 3 bar. The consequence of this is it means we need to put together a portfolio which is better on a return on invested capital measure, and in respect, also better on a revenue growth measure, gross margin, with lower leverage, lower carbon intensity. And we think this positions us fantastically to deliver excellent long-term returns to investors for as long as we possibly can. So that's it. So thank you very much, guys, and speak again soon.